What's going on, guys? Welcome back to the channel. My name is Leo, and in this video here we're going to be doing an analysis on Disney. The earnings just came out and stock price is rising, so let's take a deep dive into the fundamentals of the business and try to figure out an applicable price to pay for this company. Let's roll the intro and jump right into it. Before we jump into Disney, make sure you hit the like button and the subscribe button. Makes me feel warm and fuzzy inside, helps out with the YouTube algorithm. Without further ado, here's Disney Corporation, $268 billion company. We got stock price at $155 at the time of recording this video. Let's jump into the company metrics and do a comparison of where the company currently is to where the average is. So, PE, we have it at 141 compared to an average PE of 25.91. Guys, we want this average PE to be under 22.5, and the current PE ratio is at 141. Not looking too great there. EPS has fallen underneath the average of being 1.72 compared to the average being 4.11. We want to see at least the EPS at least either increasing or over the average. So this doesn't scream too healthy at the moment, but they did get hit the last couple of years due to the pandemic, so that might just be the reflection of that hit. Return on equity, we have 3.53% compared to 11.77. We want this number to be over 15 or 15 or higher. We don't have that on the average or the trailing 12 months. So I can't really say I'm too happy about those numbers either. Profit margin is 4.2% or 4.3 compared to 10.39. That's a decrease in profit margin. Revenue, $72 billion. Net income, $3 billion. Free cash flow, $2.4 billion, with our average free cash flow being $5.2 billion. Dividend yield is nada because we do not pay out a dividend. I believe they did before and how they cut it. Probably a better option. Jumping forward to return on invested capital, we have that at 1.68% compared to 9.95%. We want this number to be 10% or higher. We're very close with this 5-year return on average, return on invested capital here being at 9.95. Not bad, but this recent decreases, well, that's a hefty one. That just shows how well they're at least getting an investment return on their capital. I wonder why this. I guess it's just the whole COVID shutdown, right? They're a media company, right? So their theme parks or movies have all probably got shot because theaters were shut down. People couldn't go to the parks. But now they do have Disney Plus, as well as now parks are opening or have been opened up for the last little while. So I wonder why. And they haven't really released any new movies per se. I mean, there was Spider-Man No Way Home and Eternals, but I guess the budgets that they made for those films don't quite reflect, but well, in their earnings. But apparently those movies made bank. Anyways, jumping ahead to Altman Z-score, we have it at 2.19, 2.2 essentially. We want this number to be over 3. That just indicates that the company is in a safe category of not going bankrupt in the next couple of years. This 2.19, between 1.8 and 3, the company is in a gray zone, which kind of makes sense in regards to Disney because they did get hit pretty hard during the pandemic. So they probably did have a 3.0 rating for an Altman Z-score prior to this whole pandemic, and then 2020 and 2021 probably decrease it to this amount. Piotrowski score, we want this to be between 8 and 9. 9 is a perfect score. 8 is also really good, but I'll take a 7. 7 is also pretty decent. Yeah. What from this category, or these are the company metrics here, and just seeing where the company is, it just strikes me that Disney was a company that is beaten up, and now with this increasing stock price over the earnings, people are kind of feeling optimistic about it, and it might be making a rebound. Let's see if we do 5 years. Yeah, if we do a 5-year look at this company, yeah, What was our all time high was wow. Okay, so 2021 we actually we hit an all time high around 197 there, 201, 203. Interesting. And now we've actually decreased, but now the revenues are increasing, and now we're kind of climbing back up. So we weren't. So we were optimistic about Disney when it wasn't doing that well, and now that the company is doing at least on this actual rebound, it went down, but now people are kind of saying, "Oh, you know what? It's coming back, guys." Okay, interesting. I don't know some of the minds of people, the way they jump on stocks of I don't know. Interesting. Anyways, I digress. Let's jump into the financial evaluations and take a look at our checklist here. We have a score of 2, and basically our two winning categories here are EPS growth and 5-year revenue growth. Now, this is kind of a question mark for me because even though, let's say, the EPS has been growing, our average is 4.11, and our trailing 12 months is at 1.72. So this number might change. Revenue growth over the last 5 years. So you're looking at 2016, 2017 numbers essentially, give or take, and we have a 4% increase. We had a 4% increase. So definitely revenue 100% got shot. 100% got shot during that whole COVID shutdown. That's why the slow increase. Because now, if you look at the reflection, but we're still in the positive. But if you look at the reflection of 5-year net income growth compared to free cash flow growth, we're getting murdered with a 77% decrease from where we once were. So that's 0 categories there. But let's jump into these numbers here. As we saw, 5-year PE ratio, we want this over under 22.5. It's not there. Current ratio is 1.1. We want this to be over 1.5. Essentially, what this number shows is, in a case of, let's say, liquidation of the business, can the business's assets cover the liabilities? In this case, yes, technically, with a 1-to-1 ratio, but then you kind of leave the company with nothing. We want that 0.5 or that one in the 0.5 within the 1.5 to be that buffer zone. So it gets a 0 there. Return on equity average, we want this to be 15% or higher, 0. EPS growth, as I said, it is increasing, but that number could be worrisome because of the decrease that we're currently facing. The average, something to just keep in mind. But it's going to get a point over there. Debt to equity, we want this number to be under 50%. Now, what this number does, or what this ratio is indication of the company. Is it building equity? Is it leveraging its capital to build? Now, what this number is looking at the company is now with debt to equity, we want this number to be under 50%. Now, this ratio is essentially looking at the company and saying, hey, are you building or are you leveraging your capital through building equity within the business, or are you using your capital or by taking on debt to build leverage? Obviously, we want this number to be under 50% because that means the company is not taking on as much debt and building equity within the business. 58%, I'm not too concerned. It's still within that close to 60, but they are taking on debt, slightly more debt than actually building with equity within the business. So it's just something to keep in mind. It strikes me that a lot of these metrics here, it's something to keep in mind. It's not necessarily like a bad thing, but if this number does increase, it would be somewhat worrisome, at least to me. Yeah. So 60% for the debt to equity, 1.0 for the current ratio. Something to keep in mind with these debt levels here. Share dilution. The company is diluting you slightly with a 0.3% increase of shares over the last 5 years. We want this number to stay the same or decrease. Unfortunately, they're not doing that. it's so slight. It's such a slight increase. I'm personally not too concerned about it, but I would like for them to, at least for the next year, keep the shares the same, or ideally have them decrease. And as we kind of went through in the beginning, the 5-year net income growth has decreased. 5-year free cash flow growth has decreased. Return on invested capital average is under 10%, ever so slightly. I'm not gonna knock that one. It's like 0.5%. But it's a zero, no points there. So yeah, it kind of just reaffirms my belief that Disney is a company that was definitely beaten up during this pandemic period here in March 2020. The parks being shut down, theaters being shut down, the main streams of revenue kind of being, hindered. But Disney Plus is coming along, grabbing in some new subscribers, and they're going full force. They have the Book of Boba Fett and all these other shows coming out with the whole Marvel series out on there with WandaVision and all these other shows that were currently that they're marketing. I don't think this company is in too bad of trouble. It's just things have to just kind of go back to normal, and you'll see these numbers increase a lot. Now, that being said, let's take a look at a price to pay for Disney. And we'll go into our price analysis category, and we'll do an analysis for Disney Corporation. All right. Looking at revenue numbers here, we have 1 year, 5 year, and 10 year within these 3, 4, 5 range. So I'm going to just do 3, 4, 5. I mean, I think that's pretty conservative. I might even just do 4.5 just to be ultra conservative here, just to see. Because it is a large corporation, it is growing pretty slow. But I could definitely see it growing 3% a year, or even 3.5. Anyways. Profit margin. I'm gonna give Disney the benefit of the doubt and call this year just an anomaly. Even for our free cash flow margin, I'm gonna probably hover within this 5 to 10 year range. So what I will do is I'll go 8, 9, and 10, because these are numbers I know they could probably hit no problem, and 10 they could definitely hit if they hit it at the 5-year mark. And then same thing with free cash flow. I'll probably go 5, 6, and 7. Hovering in that 5-year range. And then price to free cash flow, I'll use my higher metrics and go 14, 16, and 18. And PE ratio, I'll definitely go 12, 14, and then 16. That is incredibly high. All right. Put our desired return in. I'm going to expect this to be extremely overvalued. And guess what, guys? Red across the board. Average calculation price for this company is $42. We have $52, $41, and $30 essentially what we should be paying for this Disney stock. So for this company to make sense based off the numbers that we have here, this company needs to fall a considerable amount, be in our wheelhouse of buying. I get it, people are optimistic of Disney coming back, and it is, a behemoth in media corporation of a media corporation, but at the current valuation of what you're actually buying with this company, it doesn't make sense, at least to me. $41 February, was that 10 years ago? 10 years ago, we were in that $40 price range. Yeah, right here. What that is right there? Marvel. Boom. It was right there. That was Avengers 1. And then it just kept trucking along. But yeah, Disney needs to fall 40 to 42 or somewhere around there, sub $50 for me to even think about it based off of these current numbers here. Now, if these numbers improve, then take another look at it. But for the time being, yep, Disney overvalued. I definitely think it's a company that has a lot of things going for it. I definitely think that with the increased amount of users on Disney Plus, driving that should hopefully drive more revenue. People going to the parks more, and more movies being slated to come out. And they're going to be pushing up Star Wars or Marvel until can't no more. Yeah, those are my thoughts on Disney. Staying away from it for now until it drops down to that price. If you found this video helpful, guys, please drop a like and the subscribe button. Smash that for me. And if you like what you saw on the screen here, this application right here, this will be available to you hopefully sooner than later. Making it into an app. And yeah, it's going to be for my subscribers. But please drop a like, hit the subscribe button, send me a message if you're interested in obtaining this software, because it will be available. And leave a comment down below of a company you want to see evaluated. I'll run it through the application here, and we can explore that together. Guys, thank you so much for tuning in. I'll see you in the next video. Peace out.